Hey everyone, it's Monday, July 18th, and it's time for another episode of Mayhem's Macro Monday. Sponsored by TraderAid.com. Just $20 a month or $200 a year for fundamental, macro, and technical analysis. We focus on trying to help retail traders and investors become more consistent, and we offer that through analysis, research, trading ideas, education. We also have separate offerings that include coaching, classes, and much more. So check us out on the web at TraderAid.com. The first chart we have here is from the Financial Times, and it's looking at global central banks' interest rate hikes. The darker blue shade is hikes that are between 50 and 100 bips, and above 100 bips are the lighter blue shade. And we can see that this hiking cycle is of the greatest velocity that we've seen in the last 20 years worth of credit cycles. Why does that matter? Because we probably have to go back to the 1980s to see anything of this velocity, any sort of global tightening of financial conditions that even remotely approaches this. And why does that matter? Because the difference between now and then is the world has a whole heck of a lot more debt now. There's more fragility, whether you're talking about the balance sheet of households, some of the less properly run balance sheets of corporations, although there's less of that now than we were going into 2008. Similar with financials, they're largely in better shape unless you look at some places in Europe. But when you look at governments around the world, one of the things that happened with the great financial crisis is a lot of that risk was transferred from the balance sheet of banks to governments and even to central banks. And I think that's going to be a bit of an issue as we move throughout this tightening cycle, because I do think that some of these emerging market governments already, you're seeing the worst rout in emerging market bonds ever, are under serious stress. A lot of their debt is dollar denominated as well. It's one reason we see such a flight to dollars as rates are rising. But I think that we're also looking at this from the perspective of every single other asset, whether it's long duration, when we're talking about like tech growth, crypto, stuff like that, or whether it's risky, less risky assets, but still risky assets like, equities, cyclicals. Everything is going to be under pressure in this type of environment as long as it continues, because this is not only the QT component of it draining the sort of financial lifeblood, the liquidity from the global financial system, it's also increasing the cost of capital at a time when, there's a lot of places in the world that can't really afford that. And we'll get into that more just a little bit later. The next thing is that even though the Fed has been raising rates pretty aggressively given the rate of change with these rate hikes from where they were to where they're going, they're still arguably behind the curve as CPI is extremely high versus the Fed funds rate. And while it's not a completely positive correlation, you can see that the Fed does typically try to raise rates into a strengthening economy, into rising inflation. This time it's a little different. They are behind the curve because they should have started hiking last year, probably early last year. They didn't. COVID was a lingering concern, even though it had discernibly less and less economic impact. And the Fed was, talking a lot about labor force participation. They were talking a lot about equality, all this sort of stuff to kind of jawbone the idea of keeping perpetually easy monetary policy afloat, and then the idea of inflation being transient. And we found that all that's no more true than the idea of a so-called soft-ish landing this time around. So in the yellow shaded area, we can see that inflation has kind of ripped and roared and gotten out of control while the Fed funds rate is just trying to catch up here. And while we probably see the velocity of inflation begin to moderate as we see readings go on this year due to a combination of base effects and raw materials and energy starting to roll over, energy being a big driver of inflationary pressure. Also, refining capacity is increased in June, which helped decrease the price of gasoline, and oil falling on lower demand and a larger build also helped relieve some of that pressure. So there's some chance the velocity or the rate of change in inflation will start to become a little bit subdued at the same time that the Fed is busily engaging in the best form of demand destruction they know, which is asset deflation, which is undermining the sort of risk appetite that people have in various markets by increasing the cost of capital. That's the asset deflation component. It's also destroying demand just by increasing the cost of capital in the real economy. People have higher borrowing costs. They're less likely to borrow and buy. When we look at Google, oh my goodness, look at all these people searching for a housing market crash. These are some of the same states that were just like you'd hear every day. Oh, this guy got outbid by 20 different people and this house sold for 50 or 30 or whatever % above listing. It's all going the other direction now, and it's not looking so great. And remember, real estate is a less liquid asset. It's not like people are, high frequency buying and selling houses several times an hour or a day. Instead, with houses, there's a turnover. It takes weeks or months. There's a lot of processes that go on. So real estate tends to be a lagging asset class in terms of how it reflects the underlying appetite for assets in the economy. And we can see that that's beginning to have an effect. Some of the states that had the larger bubbles are starting to see a harsher impact now that reality is beginning to set in with a higher cost of capital and a consumer that is admittedly constrained with consumer sentiment towards housing at really close to the worst levels ever. And there's reason for it because mortgage rates are skyrocketing. And while we've seen a little bit of a reprieve recently, the rate of change in these mortgage rates is similar to the rate of change in CPI. It's just staggering. And it's caused a lot of people to be priced out because while rates have skyrocketed, because houses are less liquid assets, prices have taken longer to sort of gradually fall. Though we do see more people canceling purchases, we do see more listings selling below price of the listing. So there are some signs that underneath the surface, the housing market is starting to show some serious cracks. Something that I was trying to raise some awareness on much earlier this year. I got a lot of flack for it because, it looked like things were good based on, what was going on sort of leading up to that point. But as we got into January of this year, the Fed made it clear they were going to do quantitative tightening. We saw the consumer kind of peak in what seemed to be their economic participation in the fourth quarter of last year and feeling pretty constrained. We saw home buyer sentiment dropping. We saw rates beginning to rise, and we saw a lot of markets that were just thoroughly overheated. So I just kind of tossed my hat out there and said, look, I think that the housing market doesn't look so hot. And it's not looking so hot for the housing market, the home builders, and all the sort of peripheral industries at this point. So something to be aware of in that situation is real estate is a lagging asset class for the reasons I described, and that's why it can look better than it really is while other things are falling apart. Doesn't mean it's like a safe haven. It doesn't mean that it's weathering the storm. It just means there's latency. When we look at that same housing market, deals in the housing market are falling through at the fastest clip since 2020, which is not a good sign. This is not normalization. This is not, what would ordinarily happen. If we could see, we're already above trend. So what that tells us is that, the housing market is probably showing some signs of rolling over with deals falling out. Those are people pulling out of agreements they made, and largely they're doing that because they either think they can get a better price or they don't have the capital. Either way, it's not a good sign for real estate prices moving forward. When we look at rental inflation, this is the other side of it. It's actually accelerating while wage growth moderates, and there is some lag time with rental inflation. It pretty much goes until it can't go anymore and demand starts to dry up. We're not quite there, but we're probably not so far away from it, maybe a month or two, where we start to see that rentflation or rental inflation start to moderate. And we can see that, with wages not keeping up, a lot of people cannot afford their rent. 8 million, 9 million are behind in the United States. And then I think about 2 to 3 million are facing eviction. And they're mostly people that are in the bottom 20% of income. So there is a growing amount of financial stress for consumers. We haven't technically entered a recession. The Fed is just beginning on their hiking cycle very late as we're approaching that technical recession, if confirmed. But Atlanta Fed GDP now, which with this amount of data is pretty accurate, and it's saying last read minus 1.5% for the second quarter, which would mean we have 2 quarters in a row sequentially of contraction, which would be a technical recession. So, should that manifest, and I think with a high degree of probability it will, that will drag the price of a lot of things, including rent, lower with it. But the other problem is that wages will be lost. And so a lot of people are going to lose their place, even if rent does start to flatten out, because they won't have the income to support it. Consumer inflation official versus shadow stats. So if we had calculated inflation the way we did in 1980, we'd have an inflation rate of 17% or even 20%. Why does this matter? Because what we're seeing from the Bureau of Labor Statistics is just not really good accounting of data. And it's a problem because guess what? If we're not measuring inflation honestly, then tips aren't paying out honestly. The Fed isn't reacting appropriately. People aren't preparing themselves. Businesses aren't preparing themselves. Social Security's not indexed properly. A lot of people are hurting. When you artificially subdue inflation readings, and there are reasons for it, and some of them are alluded to in what I just said, it creates a lot of problems. And one of them is also that people just don't trust the government. They know they're going to the grocery store, and inflation hasn't just gone up 10% over a year. They know they go to the gas pump. They know their rent. They know everything has gone up. Their utilities more than what the reading says. Because the readings' weightings are skewed in a way that's not realistic. People need more food and energy than the basket accounts for, just as an example. And what is the biggest component of CPI's rise? It's been energy. It's been the fastest growing component. It's also been one of the biggest weights in terms of pushing it higher, in terms of the rate of change of energy and how much that has affected CPI. Even though in terms of actual weighting, permanent shelter is the biggest weighting in CPI, and it's a more sticky measure. But energy has been a big contributor to the upward velocity in CPI. And as a result of that, it's good to look at what people consume in the United States for energy. It's mostly oil, natural gas, and less coal. Why does that matter? Because we still have a structural deficit in production of oil. So if demand ever normalizes, it will have a negative impact on CPI. And in negative, what I mean is that it would increase the velocity of inflation. So for now, we see demand destruction. We see the Fed going down the path of trying to, really subdue that demand by inducing a recession, which is exactly what their policy will do. And it's the intent of it, whether they say it or not. That's how you destroy demand. And as a result, oil prices will go down. Gas prices will go down. But as soon as the economy rebounds in the beginning of the next credit cycle, which the Fed will also induce as a response to the recession that they themselves helped to create, it's likely that normalization of demand for oil, for gasoline, would bring prices sky high. Just as an example, during the most recent readings, typically during this time from 2015 to 2019, there was over 675,000 barrels of gasoline used. I believe it was every day during summer, and right now it's something closer to like 266,000. And why does that matter? Because this is peak driving season, and we have basically a third of the demand, and prices are what they are. So that tells you there's not a lot of elasticity, and even with refiners increasing their capacity, we just don't have enough production. So it's something that we should all be kind of thinking of, that in the here and now, inflation can go down, energy prices can go down, food prices, things like that. But as we get into the next credit cycle, it's likely to be a shorter, shallower cycle, simply because there is less elasticity on the supply side. So as demand resumes, inflation will pick up more quickly. When we look at what's going on in markets this year, there's been nowhere to hide. Stocks and bonds are having the worst first half returns in history on a global basis. So when we look at the MSCI All Country World Stocks Index and Bloomberg Global Bond Index, this is unprecedented carnage. Why does it matter? Because central banks haven't really gotten around to fully tightening yet, and this is the carnage we've seen so far. Doesn't mean that everything has to go to zero, but it is likely that there's more pain ahead. We also see that expressed in the volatility in Treasury markets. Treasuries have been exceedingly volatile. In fact, they've reached levels of volatility recently we haven't seen since the COVID crash. And that's really important. Because what that means is that it's likely that volatility will permeate into other asset classes like currency, like commodities, like equities. And you can see the VIX index, which is basically implied volatility for the S&P 500 index, represented here with a pretty big discount. Why is that important? Because a lot of the time, move drags VIX and not vice versa. If that's the case here, then there is some chance that equity volatility could be brought a lot higher. In the here and now, the front month of that term structure for equity market volatility may be subdued a little bit because more institutions seem to be putting on put spreads and also doing shorting through equity shorts and equity futures, right? So they're shorting single stocks, they're shorting futures, they're putting on calendar spreads, they're putting on diagonals. They're not necessarily just buying front month puts or even 2 month out puts, and that's changed put skew lower. That's also depressed the VIX a little bit. So that's something to just take into consideration here, that there are other things going on behind the scenes that make some of these metrics a little bit less constructive because of how positioning may be changing. When we look at recessions, there used to be much more frequent. Look at all that gray in the past. It's like every other year it was like, oh, look, we're in a recession again. There's all those panics in the 1800s. Then the Fed came around. I think it was, 1913. We still saw a lot of recessions. Then eventually, as we got into World War II and just sort of this endemic of ceaseless warfare and never-ending central bank credit cycles after the 1980s, recessions did decrease. So that's a good stuff. That's a good thing, right? That's one of the benefits of central banking. But one of the bad things is some of the recessions we've had have been some of the worst we've ever had. Like the Great Depression was something that happened after the Fed. And it had everything to do with how the Fed sort of stimulated the economy in the go-go roaring 1920s. Now, I'm not saying we're going into a Great Depression. I don't think it's going to be anything quite like that. But I do think we do have a potentially difficult recession ahead of us, and it has everything to do with the last 13 plus years of excess liquidity, excess risk taking, poor management of money, and just concentration that we've seen in global markets. A lot of people are concentrated in the same 5 stocks in U.S. exposure. A lot of people are concentrated in these sort of 60-40 portfolios that haven't done very well. And just it seems to me like there's some additional vulnerability there. And also it seems to me that until the Fed turns and actually starts to pivot towards neutral and then eventually easing again, that there's little chance that the bear market is fully over. We can have some fits and starts, we can have some powerful counter trend rallies, but I think the bear market continues until the Fed pivots. And changes in new job openings, speaking of recessions, one of the things we keep hearing over and over and over and over again on financial media is how strong the job market is. It's the strongest job market. How can we call this a recession when there's so many jobs? It's not shown on this chart, but the labor force participation rate has not recovered in over 20 years, whether it was the dot-com bust, the great financial crisis, the COVID crash. We have generationally low levels of labor force participation. So we already have a ton of slack in the labor force. It's not as tight, it's just less people are participating. So if there's less people participating, it can seem tight because less people are seeking jobs. But there's more people and less of them are in the workforce. So that's not a great sign. And the Fed used to talk about it all the time last year, as I mentioned earlier. Right on this chart, we can see changes in new job openings are dropping in almost every state across the union. Why does that matter? And if you look at the whole USA in context, that's a 17% drop. Because this whole idea of a tight, strong labor force is a joke. And it's not going to be something we hear too much more of, because it's going to become abundantly clear that that was a bit mythical in nature. And also that the jobs that were being created, a lot of them weren't as good as some of the jobs pre-COVID. That started to change over the last year, but now it's starting to change back. And there's some stories of people that get these jobs, you know, they get an offer, they get the job, they're about to start, and they get a call saying, don't come in, the job doesn't exist anymore. That's happening more and more as well. We see some of the larger companies slowing their hiring. Others are actually beginning firings. We see startups that are cutting their valuations. We see high yield credit is getting more expensive. We see venture capital sitting on more and more money. So we see basically hesitation to take risk in an environment of tightening financial conditions. And that means less jobs. In the 1980s, it took a double dip recession to stop runaway inflation. Now, past is not prologue, but it's a scenario that kind of goes with what I was talking about. Why? Because it's likely when we emerge from the near-term recession that we'll see inflation come back earlier rather than later, and the Fed will be more than likely put in a position where they have to induce yet another policy-driven recession. We don't have business cycles, we don't have economic cycles, we have credit cycles. They are entirely driven by our central bank, the Fed, and that's something that's very important to keep in mind as we navigate the market, because it's not, free market capitalism or any of that kind of stuff that, sort of is at this point mythology. It really is a credit cycle driven by central bank policy that starts and stops the economic expansion as well as the bull market. In China, we see Chinese lenders falling to a two-year low. We've got a lot of people that are protesting over there, not being willing to pay mortgages on properties that are being developed. Some of that was exacerbated by COVID, but other contributing issues are developers are simply not honoring their time commitments on a lot of these projects. And that's creating some contagion risk for some of the debt out there that has exposure to it, these developers and their debt. And this kind of relates back to Evergrande and all the stuff we saw there. It's a similar kind of poor risk management, too much leverage, and a lot of bad debt floating around as a result if this thing really goes off the rails. So why does that matter? Because on the one side, it sounds really bad for China. On the other side, I think it actually does compel their central bank and government to take additional action from a stimulus perspective. I know it sounds a little counterintuitive that could be bullish longer term, but I think that we saw the same thing during the great financial crisis, during COVID, and other times here, as well as in China during COVID, where they kind of tend to overreact a little bit. Central banks tend to overshoot when they're stimulating, and they tend to overshoot when they're tightening. And I wouldn't be too surprised to see the government of China, which is engaging in some pretty aggressive monetary or fiscal policy, as well as the People's Bank of China, which is starting to lean more onto their monetary policy, just get a little bit more supportive of the markets and economies, because I don't think they have much of a choice, and inflation is still very low there. The population rate in the world population growth rate is just tanking. I know a lot of people have spoken about this. We're not replenishing humans at a rate that is requisite to, basically have a stable population. And eventually, world population is likely to slow and then eventually start to decline. This is a big problem. In the very, very long term, it's disinflationary, if not deflationary. But in the short run, what it suggests is we just have less able-bodied people, being born. And it's especially this precipitous decline has been accelerated by COVID. So there's going to be less workers. There's going to be less young people. Not in all countries, but in a lot of especially advanced countries or so-called rich countries will probably have less working people. So they either need to be, more immigration available, or we need to get into automation and robotics, or both. There's really not a lot of other solutions here. And it's something that's going to be a problem that's creeping up rather rapidly on society. Countries with the highest default risk in 2022, and this might have to be reordered a little bit. Sri Lanka might need to be added to the list here. But El Salvador, number one. Seems like Bitcoin did not fix that. The rest of this list is pretty predictable, but one thing that's interesting is you don't see many countries with debt to GDP higher than 100%, and yet there's still very high default risk. Look at Ukraine, bonds over 60%. Look at El Salvador, bonds over 31%. Tunisia, over 32%. I mean, these are unsustainable rates. There's just no way that these countries could reasonably expect to pay that kind of interest. Apple, when compared to its peers, generates the highest revenue per employee, which makes sense because a lot of their stuff is priced at a big, big premium. They make a lot of profit on every iPhone sale, every iPad sale, every Mac sale, all their services, the App Store. Everything is just incredibly lucrative. And they also don't have an inordinate amount of employees to do grunt work like Amazon, which is on the bottom of the chart because of all their warehouse workers. They're one of the largest employers on Earth. So this makes sense. And if we look at the next chart, it'll make even more sense because look at how profitable Apple is. Look at all these inputs. It makes a lot of sense as to why they make so much money for employees. Like each employee makes that much money, not for, but per, right? Important differentiation there. But nevertheless, it's also something that suggests that Apple could return a lot more of that profit to their employees if they wanted to, but they do return it to their investors, and their investors are very, very happy. Fake accounts removed by Facebook. This is the last chart, so I appreciate everyone who's tuned in this whole time. I know it's been a lot to go through here, but these are all the fake accounts that Facebook removes. Basically, every sort of quarter here, they report this information in their earnings, and it just keeps growing, and it makes sense. It's leveled off a little bit the last 2 quarters, but it makes sense. You got a lot of fake users on these platforms because the other side of it is you got a lot of people that are advertisers. Those advertisers want eyes, they want clicks, that's how they make money, and some of them aren't so honest, so they'll create fake users. There's also, political nonsense and other kinds of manipulation tactics that work on the platform. So you got other countries' governments, you got corporations, you got criminals, they create fake accounts for various reasons. So I think that's something to take into consideration, but the more important question here is how many are not removed? How many still exist on the platform? Remember, Facebook, many years ago, they counted more users in the US than the census counted human beings, which is not only comically silly, but anyone worth their salt would look at that and say, how is that even possible? It's not like every toddler and infant is on Facebook. It's not like grandma and grandpa are all on Facebook. It's not like everyone in a nursing home, a hospital, a prison is on Facebook. There was all kinds of things that didn't make any sense. And yet Wall Street took it at face value, and it eventually became one of the richest companies in the world, ostensibly lying about some of their most core metrics. But that's neither here nor there, because now they're called Meta because they had to rebrand themselves since all of the attempts at working around Apple's IDFA redaction failed. So they have to create their own metaverse, their own reality, to be able to do more tracking of user metrics and telemetry to be able to redeliver that surgical precision of advertising that they were known for. And that's probably going to take somewhere between 5 and 10 years if it succeeds at all. Anyway, that's enough about that. This has been an episode of Mayhem's Macro Monday. These are the most popular charts I posted on my Twitter feed over the last week. I tried to get it to as much as I could. There's a lot more out there, but there's just so much to cover. So I wanted to just say in closing, this whole thing is sponsored by TraderAid.com, so check us out. We just added Aisha to our team. She's an amazing fundamental analyst. She's also a banker with 18 years of experience in deal making and other areas. So we've added an incredible amount of brain power to our team with her. All three of us together, myself, Aisha, and Horst. I couldn't be more confident about the future of TraderAid. I think we're about to do some really amazing things. And stay tuned because some really cool announcements are going to be coming out from us as well. So thanks again for everyone that tuned in. Please like and subscribe to my YouTube. Remember, every day I also have a Bookmap Plus trading stream going on focused on S&P futures, and I talk macro and markets almost every day there. And check me out on Twitter, Mayhem 4 Markets, Mayhem number 4 Markets. Thanks for tuning in again, everyone. Have a great day.